Welcome back to Talk Tickers. You know, we are your shortcut to understanding what's really going on in these earnings calls. And today we are diving deep into Dollar General's Q4 2024 earnings call.
Yeah, let's break it down.
So let's start with a really quick snapshot of their results. For the fourth quarter of 2024, Dollar General's net sales increased by 4.5% to $10.3 billion.
That's pretty solid growth, and it actually pushed their full fiscal year sales over $40 billion for the first time ever in the company's history.
Wow, first time crossing that $40 billion threshold. That's impressive for sure.
Yeah.
But when we look at same-store sales, the picture gets a little more, nuanced.
Yeah, same-store sales only increased by 1.2%.
Okay, so let's dig into that a bit. What was actually driving that growth?
Well, it was entirely driven by a 2.3% increase in the average transaction amount. Basically, customers are spending more per trip.
More per trip, okay.
And this came from kind of two things, both a slight increase in the average price per item and also from customers just buying more items per transaction, more stuff in their basket.
Okay, so people are buying more, spending a bit more per item. But hold on a second. You said that same-store sales were only up 1.2%. So is that meaning that traffic was down?
Exactly. Customer traffic actually declined by 1.1% during the quarter. So fewer people are coming into the stores, but those who are coming in are spending a little bit more.
Okay, fewer customers, but bigger baskets. That's a really interesting dynamic. And what about the product mix? What were people buying?
Well, consumables led the comp sales growth, but that was actually offset by some declines in their seasonal, home, and apparel categories.
Okay, that makes sense if their core customer is feeling the pinch of the economy, maybe shifting more towards those everyday essentials. Now let's talk about their profitability. Their gross profit margin dipped a bit to 29.4%. What were the main factors behind that?
Well, their SG&A expenses as a percentage of sales actually increased to 26.5%. And a big part of that was $214 million in impairment charges.
Impairment charges, now that's often a red flag. What were those related to?
Yeah, these were tied to their decision to optimize their store portfolio. Basically, they closed some underperforming stores.
Got it. We'll definitely come back to that portfolio optimization in a minute. But first, how did these charges and the overall SG&A increase actually affect their bottom line?
Their operating profit decreased by 49% to $294 million. And out of that decrease, $232 million can be directly linked back to those charges related to the portfolio review.
Significant impact right there. And how did this all flow down to earnings per share?
Well, EPS also took a hit, decreasing by 52.5% to $0.87. And they estimated that roughly $0.81 per share of that decrease was because of that portfolio review.
Okay, so some pretty noticeable impacts on profitability. So clearly these moves to close stores, while potentially good in the long run, did have a real short-term impact.
Oh, no, sure.
But on a more positive note, their merchandise inventories did decrease by 4% year over year, and even more, by 6.9% on a per-store basis.
That's good news on the inventory management front.
It sounds like they're getting more efficient there.
Yeah, maybe. They also saw a nice 25% increase in cash flow from operations, reaching $3 billion.
Okay, so strong cash flow. What about capital expenditures?
They totaled $1.3 billion.
Still pretty high.
Yeah, and they also paid out a quarterly dividend of 59 cents per share.
Okay, so summing up their results, strong top-line growth, good cash flow, but profits definitely got squeezed by some of those strategic decisions.
Definitely.
So with that, let's look ahead. What is Dollar General expecting for fiscal year 2025?
So they're guiding for net sales growth of 3.4% to 4.4%.
Okay, still pretty decent. What about same-store sales growth?
For same-store sales, they're projecting growth between 1.2% and 2.2%.
Okay, and for earnings per share?
EPS is expected to be in the range of $5.10 to $5.80.
Okay, so that's their outlook, and it sounds like it reflects their current strategic initiatives as well as those broader economic conditions. Now, let's zoom back in on this portfolio optimization strategy, right? They're closing stores, which always raises eyebrows. So walk us through what they're doing and why.
Sure. So they permanently closed 96 underperforming Dollar General stores. Now, that's actually less than 1% of their total store base. And most of these closures were focused on urban locations.
So they're being very specific about where they're closing stores. And they also made some changes to the PopShelf concept, right?
Yeah, they actually closed 45 PopShelf stores, converted 6 others to the traditional Dollar General format, and this leaves them with about 180 PopShelf locations.
So a significant reduction in their PopShelf footprint. So I guess the big question is, why these moves? What's the thinking behind closing both Dollar General and PopShelf stores?
Well, for the Dollar General closures, it really comes down to, well, underperformance. These urban locations just weren't meeting their financial goals. Maybe it was higher operating costs, a different type of customer than their traditional rural base, or increased competition. It's hard to say for sure, but they just weren't profitable enough.
Yeah, urban retail can be tough. And what about PopShelf? What was the rationale there for scaling that back so much?
I think it's fair to say that maybe PopShelf hasn't quite lived up to their initial expectations.
It seems like a pretty big shift in strategy after all the initial buzz around PopShelf,
Yeah.
but they're still keeping some of those stores. So they haven't given up completely. What's their plan for the remaining PopShelf locations?
They're actually still optimistic about PopShelf's future.
Really? So how do they plan to turn things around?
They're really focusing on a few key things. First, they're trying to build more brand partnerships to improve the merchandise mix.
Okay, so more name brands, more recognizable products.
Exactly. Second, they're rolling out some enhanced in-store layouts, really trying to highlight those higher margin categories like toys, party supplies, candy, and beauty. And they're actually seeing some early success with this, with double-digit sales increases in some stores.
Wow, double-digit increases. That's pretty impressive. So new layouts, new products, any other changes in store for PopShelf?
They're also introducing some new product categories and developing a loyalty program and digital experience specifically for PopShelf customers. So they're really trying to hone in on that target customer and create a more engaging shopping experience.
Okay, so trying to find that sweet spot and make PopShelf really stand out. That's interesting. And it sounds like they're taking some of what they're learning from PopShelf and actually applying it to their traditional Dollar General stores.
Yeah, they specifically talked about using PopShelf insights to enhance their non-consumable offerings in Dollar General stores. This could involve things like, better visual merchandising, more enticing product assortments, and a better understanding of, those impulse purchases in those categories.
Okay, so kind of cross-pollinating ideas between the two banners. That makes sense. Now let's talk about their outlook for 2025. They're calling it macro-neutral, but still anticipating pressure on their core consumer. So how do those two ideas fit together?
I think what they're saying is they're not expecting any huge changes to the overall economy in 2025. But at the same time, they know their core customer, the value-conscious shopper, is still going to be facing some financial headwinds.
So no major economic shifts expected, but their core customer is still feeling the squeeze.
Exactly.
Okay, so that's the overall environment they're anticipating. Now, when we look at profitability, they expect their gross margin to actually benefit from their shrink reduction efforts.
Yeah, they've been working on that for a while, and it seems like it's paying off.
So less theft, less damage, better margins. Got it. But they are expecting SG&A to deleverage. What does that mean and what's driving it?
Basically, it means their SG&A expenses are going to grow faster than sales.
Okay, so not great for profitability. What's behind that projected increase in SG&A?
Well, a couple of things. First, there's the ongoing issue of retail wage inflation. They're expecting that to be in the 3.5% to 4% range.
Yeah, wage pressure is real. What else is contributing to that deleverage?
They're also going to see higher incentive compensation expense as they return to more normal levels. That's actually going to be about a $120 million headwind year over year.
Okay, so rewarding their employees for performance, but it does hit the bottom line.
Yep. That's right. And finally, they expect increased depreciation and amortization, most likely related to their investments in things like store remodels and technology upgrades.
Okay, so basically they're saying the first half of 2025 is going to be a bit rougher. What's making that period particularly challenging?
So in the first half, you've got the remodel expenses related to Project Elevate, which is their plan to refresh their mature stores. And then in Q1 specifically, they're expecting some additional labor costs as they transition away from self-checkout in some stores, and also incur some costs associated with those store closures we talked about.
Right, those store closures we talked about, so those costs are still trickling through. And it sounds like those real estate projects are going to take a bit of time.
Yeah, they're hoping to have most of those done by the end of Q3 2025.
And in terms of capital allocation, they're not planning any share repurchases in 2025. So where are they focusing their cash?
Right now, their priority is really on improving their debt metrics and keeping those investment-grade credit ratings.
Okay, so financial health over shareholder returns in the near term. Got it. Now let's shift gears and talk about their long-term financial framework. They're looking out to 2026 and beyond. What are the key targets they laid out?
So they're aiming for annual net sales growth of 3.5% to 4%, and they're expecting about 2% of that to come from new store openings starting in 2025.
Okay, so a healthy mix of organic growth and new locations. What about same-store sales?
Their target for same-store sales growth is 2% to 3% per year.
Solid, consistent growth. And what about profitability? What are their goals there?
They're really emphasizing margin expansion. Their goal is to reach an operating margin of 6% to 7% by 2028.
That's ambitious. How do they plan to achieve that?
Well, they see several potential levers for gross margin improvement. First, they think their various initiatives like the DG Media Network, which is their advertising platform, and their non-consumable strategy could contribute around 150 basis points of improvement.
So focusing on higher margin products and leveraging their advertising network.
Exactly. Then they see another 80 basis points of potential improvement by getting back to those pre-pandemic shrink levels.
Okay, so tightening up operations, reducing those losses. What else is on the table for gross margin expansion?
They also think they can squeeze out another 40 basis points by improving their processes to reduce inventory damage.
So it sounds like a lot of focus on optimizing inventory management. And what about SG&A? What are their plans to manage those operating costs?
Their SG&A strategy is really all about driving efficiencies. They're looking at things like work simplification programs, just general operational improvements, and reducing their spend on store repairs and maintenance. They're also aiming to optimize their capital expenditures to better control those depreciation and amortization expenses. And longer term, their target for annual capital expenditures is roughly 3% of sales.
Okay, so really trying to control costs across the board to support that margin expansion.
Exactly.
And they did mention the possibility of restarting share repurchases, right?
Yeah, they're hoping to start doing that again as early as 2027, but only if they make enough progress on their financial goals.
Okay, so contingent on hitting those financial targets. And finally, what about their long-term earnings growth?
Their goal is to achieve annual adjusted EPS growth of at least 10% starting in 2026.
Okay, so a clear ambition for sustained profitability growth. Now let's dig into some of those key initiatives they're banking on to actually achieve these goals. First, let's talk about improving the in-store experience. What specifically are they doing there?
Well, they're really investing in retraining their store employees to provide faster and friendlier customer service.
Okay, so focusing on that customer interaction.
Yeah, they're also simplifying their operating model in stores.
What does that involve?
Well, they're further reducing inventory levels, trying to boost the productivity of their product SKUs, and being more strategic about their assortment and allocation.
So streamlining the back-end operations to improve efficiency. And they also mentioned some upstream efficiencies. What does that mean?
Yeah, they're working on things like improving their sorting processes in the distribution centers and optimizing their case pack sizes. It's all about getting those products onto shelves faster and more efficiently.
Got it. So smoother operations from the warehouse to the store.
Exactly. And they're also planning to wrap up the rollout of their next generation point of sale system in the first half of 2025.
Okay. New technology to help streamline checkout.
Exactly.
Now, they also talked about Project Elevate. What's that all about?
So Project Elevate is their remodel initiative, specifically for those more mature stores that aren't due for a full remodel just yet. These are more like refreshes, focusing on upgrading some physical assets and making merchandising improvements.
Okay, so sprucing up those older stores, what kind of results are they hoping to see from that?
They're aiming for a 3% to 5% lift in same-store sales in the first year after these refreshes.
Okay, so a decent bump in sales.
And they're also hoping to reduce those ongoing repair and maintenance costs by doing these more targeted upgrades.
Okay, so saving money in the long run. Now, what about their digital strategy?
Well, they're seeing increased customer engagement across all their digital channels, their mobile app, their website, their delivery options, and the DG Media Network.
Okay, so a lot of activity across the board. What are some of the highlights there?
Well, their partnership with DoorDash is continuing to expand, and they've now integrated SNTP and EBT payments into the DoorDash platform.
That's a huge step in making their products more accessible to a wider range of customers.
Right, and they're also aggressively expanding their own delivery service, DG Digital Solutions. Right now, it's in about 400 stores.
Okay, and what's the plan for that?
They're hoping to have it in up to 10,000 stores by the end of 2025.
Wow, it's a huge rollout. So they're really betting big on their own delivery network.
They are, and they're also seeing higher average basket sizes with their own delivery service, which is encouraging.
Makes sense. Convenience often leads to bigger purchases. And they're also continuing to invest in the DG Media Network, right?
Yep. They really see that as a core part of their strategy, both for personalizing the customer experience and for generating advertising revenue.
Okay, so a lot going on in the digital space. Now, let's touch on their non-consumable strategy. How are they planning to grow that part of their business?
Their goal is to grow the non-consumable mix by at least 100 basis points by the end of 2027. They want that to represent about 20% of their overall sales.
Okay, so a significant increase. How are they going to make that happen?
They've got a four-pronged approach. First, they want to build stronger brand partnerships to offer more attractive, higher quality products.
Okay, so leveraging brand recognition to drive sales.
Exactly. They also want to revamp their treasure hunt rotational home assortment to create more excitement and those impulse buys.
Okay, so keeping things fresh and interesting in the home goods section.
Right. They're also going to be reallocating some shelf space within the home category, really focusing on the most productive items.
Makes sense, making sure every inch of shelf space is working for them. And what's the fourth part of their plan?
The fourth element is all about increasing productivity by introducing newness into those planograms and space allocation more frequently. They're also planning a big marketing push to highlight both the value and the breadth of those non-consumable offerings.
Okay, so getting the word out and making sure customers are aware of all the great deals they can find.
Yeah, that's the idea.
Now, they also share some insights into what they're seeing from their consumers. What were the key takeaways there?
Well, they're seeing that their core customer is continuing to face, a challenging financial environment.
So the economic pressures haven't really eased up.
Right. But they're seeing their core customer adapt their shopping behavior, really stretching their dollars.
Makes sense. People are having to be more careful with their spending. And what about those trade-down consumers they talked about?
Yeah, that was interesting. They're seeing an acceleration of the trade-down trend, meaning more mid and upper income consumers are shopping at Dollar General.
Wow, that's significant.
Yeah.
So their value proposition is resonating with a broader customer base.
Exactly. And they're also keeping a close eye on potential changes to things like tariffs and government programs, which could really impact their customer base.
Okay, so staying informed about those external factors. Finally, how do they view the competitive landscape?
Well, they're watching their competitors very closely.
Any particular competitors on their radar?
They actually specifically mentioned the closures of Party City stores, which they see as a potential opportunity for PopShelf to maybe capture some of that market share. They also see ongoing opportunity to take share from drugstores.
Okay, so some specific competitors in mind. And overall, how do they feel about the competitive environment?
I think they feel pretty good. They see that ongoing trade down trend as favorable for their business model.
Right, if people are looking for value, Dollar General is well positioned to benefit.
Exactly. And they see those investments in delivery and the DG Media Network as key differentiators.
Okay, so focusing on what sets them apart. Well, that was a great overview of Dollar General's earnings and their strategic outlook.
Yeah.
Now, for our signature segment, this is not financial advice, outrageous but plausible trade idea. So what's your wild but maybe not so crazy trade idea based on what we just discussed?
Okay, well, here's an idea. They're making a really big bet on their delivery network. They want to roll that out to thousands of stores, and they're really targeting rural areas where, frankly, other retailers might not be as strong.
Okay, so capturing that underserved market. I like it.
And at the same time, they're seeing that trade down trend accelerate, which means more and more people are looking for those value-oriented options.
Right, so a growing market and a great way to reach them. So what's the trade?
The outrageous but plausible trade would be to go long Dollar General.
Okay, long Dollar General.
And simultaneously short a basket of traditional grocery stores.
Interesting. Why grocery stores specifically?
Because I think they've been slower to adapt to this whole delivery model, especially in those rural areas.
Okay, so you're betting that Dollar General, with their aggressive push into delivery and their focus on value, could actually take market share from those slower moving traditional grocers, particularly in those less densely populated markets.
Exactly. Dollar General might be able to capture those everyday essential purchases that people used to make at the grocery store. Now, I got to emphasize again, this is purely speculative, not financial advice. Just something to think about.
Yeah, always good to be thinking about those interesting investment angles. Well, that wraps up our deep dive into Dollar General's Q4 2024 earnings call. We covered a lot: their financial performance, their strategic changes, their outlook, and some potential opportunities and risks. What do you think? What really stands out to you, either as a potential opportunity or maybe a red flag? Always good to keep those critical thinking caps on.
Yeah, definitely.
And remember, this has been a condensed analysis. We always recommend you check out the full earnings call transcript for a deeper dive.
That's right.
Join us next time on Talk Tickers, where we'll break down another earnings report. Thanks for listening.